He controlled more than a city. He controlled a continent's power, but $1 of his own money bought him dominion over thousands. For every $1 Samuel Insull put in, he pulled $2,500 of public capital into his web. 95 holding companies, 255 operating firms, a pyramid of names and numbers reaching into the pockets of ordinary investors. Then the markets broke. In weeks, decades of construction collapsed. He left the United States as investigators closed in. What followed was not just a company failure, it was the blueprint, a technical blueprint, for how empires built on leverage and secrecy fall apart. Listen closely. I'll take you inside that blueprint. We'll look at the architecture. We'll trace the exact mechanisms. And we'll show how a design born in the age of coal and incandescent light would later be echoed in the fall of one of America's most modern corporations. Samuel Insull arrived at center stage as electricity became the everyday miracle. He learned the business from men who built the first electric grids. He believed in scale. He believed utility service should be reliable, cheap, and abundant. He bought small local companies, combined them, centralized operations, and drove down unit costs. Town by town, city by city, the wires and poles came under his control. For customers, that often meant lower rates and better service. For investors, it appeared to mean steady dividends and growth. But the public face was only the surface. Under the surface lay a design whose genius was also its vulnerability, a cascading network of holding companies sitting above operating utilities. Insull's empire wasn't a single corporate tree. It was a forest of interlocking legal entities. At the top sat a handful of shells. Below them, other shells. Below them, operating companies that actually ran the generators and sold the power. 95 holding companies. 255 operating companies. Big numbers. Bigger consequences. How did one man's dollar convert into control of $2,500 of public investment? The answer is leverage by layering. Imagine a stairway of companies. At each step, a parent company owns a majority of the next step, but does so with very little of its own equity and a lot of borrowed money or capital raised from the public. Each company in the chain issues securities to outsiders, bonds, preferred stock, common stock, and uses that money to buy the company below. The parent can control the lower company because it owns a majority of its voting stock. But ownership has been achieved with borrowed money or money from outside investors, not the parent's own capital. Repeated often enough, the control multiplies. A tiny stake at the top becomes a big claim on the assets and cash flows far down the chain. Intellectually, it's elegant. You conserve your own capital, you amplify control, you grow fast. Practically, it's fragile. The whole thing depends on confidence in asset values, uninterrupted access to credit, and a steady market for securities. Insull's empire was assembled exactly this way. Public investors held securities issued by many of those holding and operating companies. The money flowed upward in dividends and interest, until it didn't. Public confidence underwrote the structure. When the market stopped believing in the valuations beneath those securities, the support beams came loose. There's another tool Insull mastered, the use of public capital as currency. Instead of buying assets with his own cash, he issued shares and bonds into the public markets. That public capital bought more companies, which issued more securities, which bought still more companies. With each new layer, the amount of external capital controlled by Insull's directing hand ballooned. It's how his empire reached multi-billion-dollar scale in an era before the word consolidation had anything like today's meaning. Then the calendar turned to 1929. The crash was a shock to markets everywhere. Prices collapsed. The securities that had been propping up Insull's web dived in value. Loans were called. Investors fled. In a structure dependent on rolling financing and steady asset valuations, a sudden contraction of capital availability is existential. The cascade that had been hidden in layers of corporate paper became visible in defaults, in halted payments, in chairmen's offices, emptied of staff and ledgers open to auditors. Within weeks, the empire unraveled. Bonds lost value. Holding companies could no longer meet interest payments. Credit lines evaporated. Regulators and prosecutors smelled trouble and began to trace the roots of cash and collateral through the maze of entities. Faced with a flood of inquiries, Insull left the United States. He was no longer a lone builder of utilities. He was the center of a scandal about leverage, disclosure, and public risk. Pause there for a moment. The mechanics we just traced, pyramiding ownership, issuing public securities at multiple levels, repeated borrowing, and a dependence on market confidence, are not relics of pre-war finance. They are design choices. They can be built again, in different clothes, with different legal forms, and with modern accounting. This is the forensic angle. If we isolate the architecture, the exact way leverage was layered and secrecy was embedded, the parallels to late 20th century corporate failures become striking. Consider Enron. On paper, it was an energy trader, a pipeline owner, an innovator in markets. Behind the paper, it built a network of special-purpose entities, SPEs, and partnerships. Those structures moved liabilities, guaranteed debt, and engineered transactions so losses were rarely consolidated on Enron's balance sheet. The company used mark-to-market accounting to record future profits immediately, but it funded illusory earnings through circular trades and related party deals. Credit agreements were layered. Off-balance sheet obligations were hidden in legal forms. For the outside investor, the consolidated statement looked healthier than the firm's true cash flows. Sounds familiar? It should. Replace holding companies with SPEs and pyramiding with off-balance sheet layering, and the same risks are visible. Both systems convert investor capital into an expansive control claim by scattering liabilities and assets across legal entities. Both create opacity that makes it hard for auditors, regulators, and outside investors to see consolidated exposure. Both rely on continual market confidence, the willingness of banks to roll short-term financing, the willingness of investors to buy securities, the willingness of counterparties to maintain trades. And both fail the same way. When confidence stops, the structure's hidden obligations surface, and the network that seemed resilient collapses in a sequence of defaults. Let's be precise about the technical parallels. Structural pyramiding. Insull used literal holding company pyramids. Enron used SPEs and partnerships layered around the parent. Both concentrate control at the top while distributing the cash claims and the legal obligations across the bottom layers. Off-balance sheet leverage. Insull achieved leverage by issuing securities at subordinate levels and leaving the parent with limited direct equity risk. Enron did the modern equivalent by keeping debt and liabilities off the consolidated balance sheet through legal devices and accounting classifications. Circular financing and related party transactions. Insull's network shifted payments through affiliate companies. Enron executed trades between Enron and its SPEs that moved cash in loops, concealing true economic exposure. Reliance on market liquidity and refinancing. Insull depended on continuous access to capital markets for new securities and refinancing. Enron depended on credit lines, repo agreements, and the willingness of counterparties to keep transactions open. In both cases, liquidity was the Achilles heel. Misaligned incentives and hidden guarantees. Both networks obscured where guarantees and contingent liabilities sat. Insull's complex network meant that losses in one corner could be hidden until they came due. Enron's SPEs were often backed by Enron via implicit or explicit guarantees, sometimes undocumented. Understanding these parallels is not just academic. A forensic study looks at flows, cash in, cash out, related party guarantees, how collateral is pooled, and where control rights reside. When you map those flows, you see the same pattern. The upstream controller has outsized control with limited upfront capital. Downstream entities carry most obligations. The link between public investors and ultimate control is mediated by layers of securities whose valuations are sensitive to market sentiment. Here's a simple thought experiment to make the math intuitive. Suppose a parent company owns 51% of a subsidiary, which owns 51% of another, and so on. $1 of equity at the top controls the cash flows of many dollars at the bottom, because each step requires only a sliver of real capital to maintain voting control. If instead of 51% ownership, you add leverage, debt, and preferred stock raised from public investors, the same control can be achieved with even less of the parent's money. Repeat this across dozens of entities, and the aggregate public capital controlled can be thousands of times the founder's equity. That's how Insull's $1 commanded $2,500. Why is the phrase architectural blueprint apt? Because corporate law and accounting rules can be used to build structures that legally separate economic substances from appearances. If you like to think in blueprints, the beams, joints, and fasteners of Insull's model are recognizable in Enron's model. Multiple legal shells, transfers priced to move earnings and valuations, and dependencies on unsecured market liquidity. The modern instruments are different: derivatives, swap agreements, complex tax structures. But the engineering problem is the same: how to create the appearance of solidity while hiding leverage and contingent obligations. If you're following along and this is gripping you, consider subscribing for more forensic histories like this. I'll keep these deep dives calm and careful. Back to the timeline. Insull's fall led to political pressure. People who had trusted utilities with their money and relied on steady power felt betrayed. The public demanded change. State and federal reforms followed. The Public Utility Holding Company Act of 1935 reorganized and restricted holding company structures. It forced consolidation and transparency. It aimed to end the kind of pyramiding that had concentrated control while spreading risk to unwitting investors. Enron's collapse led to a different set of reforms. Sarbanes-Oxley tightened disclosure, reformed audit oversight, and created new criminal penalties for fraud. Congress and regulators focused on accounting rules, on off-balance sheet financing, and on the auditor's role. But the echo remains. The same engineering vulnerabilities reemerged under new names. Each crisis teaches similar lessons, phrased in contemporary jargon. And there's the human cost. Insull's collapse wiped out investor savings, cost jobs, and eroded trust in markets. Enron's collapse hurt employees' pension plans, shook energy markets, and reverberated through corporate America. When complex structures fail, the consequences fall on people who had no role in the architectural choices: employees, retirees, small shareholders, and ratepayers who must now shoulder higher costs or face reduced service. This is why the forensic study matters. It's not a game of intellectual curiosity. It's about identifying the exact points at which legal form becomes a tool for opacity, where accounting choices become instruments of concealment, and where governance structures fail to align incentives. It's about asking which mechanisms allowed control to be amplified, and where did those mechanisms create fragile dependencies. Only with that level of detail can regulation be targeted, not to punish complexity per se, but to require transparency where opacity creates systemic risk. Let me show you one more clean example of the mechanics at work. Consider a holding company that wants to acquire assets far larger than its equity. It creates a subsidiary and capitalizes that subsidiary with bonds sold to the public. The bond proceeds by the operating assets. The subsidiary pays interest to bondholders, and those payments are funded by the operating cash flow. If the operating cash flow declines, the subsidiary defaults and creditors move in. But if the parent is structured so its equity sits above the subsidiary and is legally insulated, the parent may not legally owe the subsidiary's debts, even though the parent benefits economically. That legal insulation is precisely what makes the structure tempting for those seeking to limit downside while maximizing control. The temptation is the same in every era. The legal forms change. As we approach the final act, the emotional intensity tightens. These are not just financial instruments and balance sheet lines. They are tools that rearrange who bears risk. When markets are stable, those who design the structures profit richly. When markets reverse, those same structures become contagion mechanisms. So what do we do with this knowledge? First, we recognize patterns. Knowledge is a first line of defense. Second, we demand real consolidated disclosure. Not only the parent's headline numbers, but clear maps of where liabilities and guarantees live. Third, we strengthen governance so that directors ask hard questions about related party transactions, about the liquidity needs of affiliates, and about the true degree of leverage in an entire corporate group. You can imagine a small investor decades from now reading a prospectus that lists rows of entities and legalese, or an auditor tracing cash through a maze of transfers, or a regulator building a unified registry of public claims and guarantees. Those are the kinds of practical changes that can make architecture transparent instead of secret. We started with a startling ratio, $1 to $2,500. We began with an empire of 95 holding companies and 255 operating companies. We ended with a crash in 1929 that sent Samuel Insull out of the country and into history as both a builder of public utilities and a cautionary tale. Between those points lies a technical story about leverage, secrecy, and the human cost of financial engineering. Between those points lies a blueprint that later architects would imitate and, because the basic mechanics are universal, repeat. If this story stayed with you, share it with someone who likes slow, careful history with a sharp forensic edge. Leave a comment. Talk about it with friends. These aren't just old scandals. They are lessons about how modern finance still builds houses of cards, sometimes using smarter cards. The last thing to remember is this: design choices matter. When power is centralized in networks of legal entities, when capital is pulled from public hands through layers of securities, and when disclosure is an afterthought, the system can look robust and be brittle at the same time. Samuel Insull's empire rose like a cathedral. When the wind changed, the facade fell. A different technology, a newer accounting standard, and different labels for the same structures don't change the fundamental dynamics. Insull's fall wasn't a one-off. It was a pattern. And patterns repeat until someone redraws the blueprint. Thank you for listening. If you want more episodes that unpack the technical anatomy of financial failures, subscribe and stay tuned. Keep your curiosity sharp and your questions closer, because understanding the architecture of collapse is the first step toward preventing the next one.